rolling here.
Good evening, everybody.
Hope you guys all had a good day today and been enjoying being in the room, and hope you had some time over the weekend, like we mentioned, to go back through, catch up on some videos, catch up on some training courses, watch some webinar recordings, be ready to roll this week. Hello, buenas noches, everybody. All right. Well, we're going to get rolling here. We've got a lot to cover, so we're going to just plow right on through. So welcome everybody to this Apex webinar of Be the Sniper or Be the Target. And if you're not sure which one you are, you're the target. So it's your choice to make it today. As always, got to pop up our disclosures here. Trading involves risk. Make sure you know what you're doing before you do it. And for those of you that are brand new, we've got a lot of you that are joining us here for our current Apex Open House that's running right now through December 4th. So make sure to get signed up for that. If you haven't signed up, go to apexinvesting.com/Apex Open House. You can sign up, get 30 days free with no credit card, and then get your the next 30 days for only $1. So make sure to check that out. Get rolling right away. Get free access to, the training courses for the Apex indicators, the toolkit for the sniper trading system, access to the live trade rooms. Check it all out. Hop in and join us. So this webinar tonight, I just want to make sure that you understand, tonight we're going to be talking about the hidden divergence trades, and we're talking about what those are, kind of just building on that foundation, giving you a deeper understanding of some of what you've already learned and some of the past webinars that we've already done. So I want to make sure that everybody knows where to go just real quick here. So if you log in to the Apex website, you'll come here to the home page, and you want to go right here to the Apex Sniper Trading Bootcamp. Everything you need is on this page here, starting off with a welcome video, and then going into signing up for the upcoming webinars. So make sure to go here and sign up for webinars. Watch the intro video here, access the Elite Trade Room here, right here under step number 3. Get your chart set up, understand the platform, and then right here, understanding the sniper charts. So some videos here you definitely need to watch. All right, some of these are a little bit longer, but they're very in-depth. It's really going to help you understand. But particularly want to draw your attention to these bottom two here, these two webinar recordings here. Okay, and I want to show you where some more are. If you go down here to step number 8, webinars, and you click that, under section D, this is the most recent webinars. So if you scroll down here, you're going to see understanding levels on the sniper chart, understanding order prints on the sniper chart, the filtered TX made simple, and last week we did the making the double TX trade simple. So we're kind of going back through, even though you have these in the step-by-step training, we're kind of going back through these, simplifying them a little bit, going a little bit slower for you, showing you the how and the why and the what, and really giving you a better understanding of what's on these charts. So tonight's webinar is going to assume that you have watched some of these, especially these last couple. If you haven't, that's fine. Feel free to go through this with us. It'll all start to come together, but make sure that you do go back to step number 8, section D, and watch these last 4 especially, okay, in addition to the others, but that will really bring everything together here for you that we're covering tonight. All right, so that's where those are. Make sure you watch all those, understand the charts, really help you understand what walls and levels and obstructions are, because we talk a lot about the trading system, and in each different trade, what are the entry rules? What has to set up? What has to happen in order to take a trade and enter a trade? But at Apex, we talk a lot about when not to trade, okay? And hanging on to those profits and taking the probability trades, not just the possibility trades. All right, so you really got to go back and understand some of those things. Really sets the foundation of everything, and then we can build on that. So like I said, this webinar will kind of assume you've watched those. Real quick here, we got a lot we're going to cover. Tonight we're focused on the hidden divergence trade setup. Okay, no, it's a little bit late of a start here, so please help us stay on time. Please keep the questions, if you have questions, please keep them focused on what it is we're covering and what it is we're covering at that time. just so that we can get through the information. If we don't answer a question right away, it's not that we're avoiding you. Your question will be answered in the next section, or hang on to it till the end, or ask it in the proper room. But help us stay on time tonight and get through what we've got going here, okay? So let's talk first about an apex indicator that's on your chart. And it's called the Oscillation Detector, or you might hear us refer to it as OD, okay? The Oscillation Detector measures the volume in a trend, okay? And it paints numbers near the bars. It's basically measuring the strength, the momentum, the volume in that trend, giving you an idea of the strength or weakness in that trend. All right, it ignores single bar reversals or elevators in the trend measurement. It measures from the lowest point to the highest point of that trend, giving you an idea of, the strength there. It's a different measurement than some of our other indicators, or DR, the deviation reversal. So you kind of get to see that strength and weakness from a little bit different view and get the overall picture. So it helps us, again, kind of combine some of the edges, give us a little bit different vision in stacking those edges. Now, I want to show it to you, explain it to you. Don't get wrapped up in what the different colors are of the numbers, okay? Let me pull over a chart here. So what I did, I took a sniper chart, okay? And I took everything else off of it, except for a couple things, because I want to make it real simple for you, okay, without everything else here. So what is the oscillation detector? It's these numbers that you see here. Now on your sniper chart, each bar is going to have a little number on top of it. Okay, that's part of order prints. It's called volume score. Okay, so don't confuse that with these numbers here. Okay, and an easy way to distinguish the OD, or oscillation detector number, is it's a little higher up. It's not right above the bar. But if you're using the regular template, it'll also have a percentage number next to it. So that's what these numbers are. Okay, let me switch over here to this. So these white numbers you see here, these yellow numbers you see here, that is the oscillation detector. Okay, now what does it mean? Well, basically, you see this number right here, 1509. What that's measuring, because you see this other one down here, 609. This push down in the market, okay, this number right here, this OD number, gives you the momentum volume number for this push down in the market, okay? This push up in the market is signified here of 1509, all right? Then we see these couple of bars down, volume is 314 there, okay? Then this push up, 1498. See that? Notice right here where there was a few bars that went up, and then there was one down close bar. Then it kept going up. Notice you don't have a new number there. This doesn't reset just on one reversal bar, or a one bar reversal. Okay, so the measurement from here to here is measuring all of that volume and momentum push. Okay, so to give you an idea, this push up in the market was 1509. This next push up was 1498. Close, but a little bit less, right? Okay, so basically the percentage number here, this percentage number is comparing this number of this push up compared to the number of the last push up. Okay, 453, or I'm sorry, 1509. All right, does that make sense? So let's look at a couple of things here. Let me just move over here. Okay, so I want you to take a look at something here. Obviously, this market is trending down. All right. Now again, don't get caught up in whether it's a white number or a yellow number. What the yellow number is it's signifying a double top or double bottom, meaning where the last push down ended and registered volume is close to the level where this one also registered as well. Does that make sense? How this right here, this level is pretty close to this level. So it just happens to pop up as that yellow number saying, hey, it's close. Notice how this one, when it pushes way down, just registers a white number because it's nowhere near the last one. Okay, but don't get caught up in that. So note, as the market's pushing down here, this first big push down registers 2107. Okay. Now, then the market pushes up and you have this number here of 877. So it's measuring the momentum, the volume push up. Now it's coming back down. And this number is measuring this push down. Okay? Does that make sense? The number on top is measuring the push up. The number on the bottom is measuring that push down. Just like here. As it's coming down, it registers that number here. So this number here, 2083, is measuring this push down. This number on top is measuring this push up. So real quick here, notice this push up that registers at 563. It's saying that's 222% greater than the last push. Now notice this last push was 2083. It's not comparing this down push to this up push. It's comparing the last push up, the last measured push up, to this current push up. Everybody understand that? Okay, so the numbers up top are measuring the push up. The numbers on the bottom are measuring the push down. The percentages are comparing that particular push up compared to the last push up. Has nothing to do with this push up compared to this push down. Okay? Everybody understand that?
That's
Okay.
really like you have to get that down to understand HD. So is that like 100% clear, or is anybody lost on that concept?
Yeah, because if you don't get this basic part of how the indicator works, the bottom number or the top number, or the percentage, or where that percentage comes from. Because a lot of people get confused on that. They want to compare this number here to this number here. And you don't want to do that. When you're looking at, for example, here, okay, this is a downtrend, right? I mean, obviously what you want to do is when you're looking at the downtrend, if you want to look at the pressure, the momentum, the strength going down, you're only going to want to be looking at these numbers on the bottom. This measures this push down in the downtrend. This measures this push down in the downtrend. This push down in the downtrend. This push down. That makes sense? Okay. And then from there, if you think about it like this, and I really wish we had a different drawing tool here. So this number here, so this market is trending down. Everybody can agree on that, right? No question about that. No confusion about that. This market is trending down. And you can see the strength of the down movement with each push down. Yes? Everybody follow me? So now in a downtrend, what typically happens? Does the market go from point A to point B? Or does it normally push down and then it pulls up, right? There's our first pull up there. It pushes down, then it pulls up right here. Pushes down, pulls up. So these numbers, so this is a downtrend, and we get the measurement of the strength of those pushes down. But we also get the measurement of the retraces. How strong is the pullback, right, before it goes back down? Okay. So the smaller the number, percentage, the weaker the trend. Well, we're going to talk about that some on next week's webinar. But yes, that is something you could look at as you see the strength of the pushes down getting weaker and weaker and weaker. That can be an indication of a potential change in the direction. of the
That's what we'll
trend.
cover Thursday.
Thursday, right, next webinar. So, but we also want to be able to see what is the strength of the pullback that goes against the trend, where it pulls back and retraces, and then it goes back in the direction of the trend. Pulls back and retraces, then goes back in the direction. So tonight, that's what we're going to talk a little bit about. Is we're identifying that the trend is short, but we want to look at what is the strength of the pullback. How much volume and momentum, how many people are coming in trying to push it the other way and getting rejected, say, nope, we're still going down. Trying to push it back the other way, nope, we're going down. Trying to push it back, nope, we're going down. We want to look at that a little bit, okay? So everybody understand the difference of what these numbers are. The push one way and a measurement. The push another way and a measurement. Okay? All right. So now that we've got a basic understanding of the oscillation detector, and you kind of understand how to read that, I want to talk to you about a term called hidden divergence. Now, I need everybody to stop typing right now, stop thinking of a question right now, stop doing anything else right now, and just really get this one thing right here. You will be totally screwed up in the head. You will totally take the wrong trades. You will totally be confused, and you will totally ask a million questions if you don't read this line right here. What I'm going to show you tonight, and what Daryl's going to show you tonight, hidden divergence. We only look for HD, hidden divergence, in trending markets. Okay? This type of hidden divergence we're teaching you here is only for trending markets. If you start trying to look for this in choppy markets, coil chop markets, 2 to 3 bar chop markets, ranging markets, it'll screw you up because it's not meant for that. Okay? So one more time. John repeat slow style. We only look for and utilize hidden divergence in a trending market. Okay? And HD entries, okay, combined with the sniper entries can be great moves, especially off of levels, and they can be a little bit bigger moves, not just scalps. Basically what hidden divergence is, it's a pullback against the trend with some extra strength, okay, but it is then ready to shoot off back in the direction of the existing trend.
And he'll show you how to quantify that in a second.
Right, we'll show you that. I'm going to show you some examples of that. Any of you guys familiar with archery? Imagine the archer pulling back on the bow, right? You know some of those old-timey bows, right? Back in the olden days where they had to pull way back on that bow, right? To get it to go anywhere. Compared to nowadays, you know what a compound bow is, right? Where you got the different pulleys of the compound bow and they're weighted, right? You got a lot of extra weight there too. I mean, you don't even have to pull them back that far for them to have a ton of weight and pressure and strength behind them. And then let it go, and it goes, you know, it goes much further because of that extra weighted than something that was not as strong that got pulled back even further. Okay, what does that mean? Let me explain it to you, but you'll understand the analogy here in just a second. Okay, so there's a couple of hidden divergence indicators here that are already on your sniper chart. Okay, so again, the market is in a trend. It pulls back with more strength, but a smaller move, meaning the market does not go as far on more volume. Let me show you a little bit here. Okay, we have a trend, right? What direction is the trend going? Pretty clear. This market is going in an uptrend. Yes? Now, where do we really start to know that? Well, if we look at the left side of the chart here, the market's coming down. It's finishing up a downtrend. But here we start to, get a higher high compared to this last high, and we get a higher low. Then we make a higher high, and it pulls back. And we have a higher low than down here. Higher high, higher low than down here, right? We can see that the market's starting to trend, okay? So we come up here, we pull back. We come up here, we pull back. We come up here, we pull back. And then right here, we come up and we pull back. Notice this last pullback here, okay? Because the market's going up. What we're looking for with hidden divergence is we know the market's going up. We want to see the strength of the pullback against the trend, like an archer pulling the bow back, or you know what I mean, or pulling a slingshot back, and then release. Let it go up further. Let the archer pull the bow back, and then release. Archer pull the bow back, release. That makes sense? So we want to look at the strengths of these pullbacks against the trend. Notice this last one here. It was measured 267. You see that? Everybody see that? Market comes up, makes a little pullback, registers 267. Then it shoots way up. Then it pulls back here. And what does it measure? 749. That's 281% higher than this last pullback. So think about it like this. In this pullback, the market price action only came down to right here on just 267. A little bit later, the market had almost 300% volume in it, and it only pushed back to here. Meaning, with 3 times the volume, it didn't break. With 3 times the volume, price action didn't break the bottom of the last price action pullback. Does that make sense? Where it did less, price action pulled back less compared to here, but on more volume. So there was 3 times the volume pushing it back down, trying to fight the trend, but it couldn't even get back to where it was the last time they fought. Does that make sense? Where volume in that direction is higher than the last time, but price action did not go as far. Volume was higher, but price action did not go as far.
So it made a higher low with a lot more volume.
Right. Is anyone confused on that one piece and that one example right there? Let me show you another example. This pullback, 749 is the volume count. So the market goes up even higher, so we're still trending higher. Then it makes another pullback against the trend. And look at the volume, 1,071. So this pullback was 143% higher than the last time it tried to pull back. And the last time they tried to push it the other way, they got to here. Now there's even more strength coming in, and they only got to here. They couldn't even get back down to the last time. That makes sense? So volume is higher, but price action does not go as far. It's as simple as that. That's what's called hidden divergence. Okay? To where, take a look, let's see here. Because if you imagine the market pushing in one direction, you've got strength pushing it that way, right? And for it to change that direction, you would need a good push coming the other way. But then you see a couple times here, hey, a lot more volume came in, almost 300% more. Boom, they didn't get really far. Goes up more, even more volume comes in going back the other way. Boom, they didn't get very far. That's called hidden divergence. So does that example there, that should explain the basics of hidden divergence. But do you also understand how that is only useful in the trend? Right? Because we want to see the trend. We want to see the overall push up. We want to see what comes and fights against the trend and then goes up. Fight
So you have
against the
to
trend, go up.
so you have to have two pullbacks in a trend to be able to have an HD. You can't compare it to the bottom number from the downtrend.
Correct. See this last push down here? This was a downtrend, and it showed you this number here. That number is measuring the downtrend. You have to wait till you've got a confirmed uptrend. So a push up and a pullback, a push up. Okay. Once you're in a confirmed uptrend with at least one pullback and then another push up, then you can start looking for hidden divergence. Hidden divergence can never be on the first pullback or on the first retrace of a trend because you haven't established that trend yet. You have to have a clear push up, a pullback, a push up, and then you can start looking to measure the pullback differences. Okay? So, do you just kind of see in this example here that these pullbacks that had much higher volume compared to the last one, they pull back, they get rejected, and the market goes the other way. Do you see how those are decent moves up? Pull back with a lot more volume, gets rejected, the market goes the other way, decent move up. Okay? So you guys see that? To where, kind of like we talked about with some of the trapped orders and exhaustion boxes and some of those where you've got all this volume coming in wanting to go the other direction. But it's getting rejected like, we're not done, we're still going. Volume coming in wanting to go the other direction, no, we're not done, we're still going. So it's another way, like when we talked about the trapped orders and exhaustion boxes, we were digging down to the tick of the bottom of these bars before they reverse. This is kind of zooming out a little bit and looking at the complete push down and measuring that. The complete push down and measuring that. We're seeing it from a little bit zoomed out view of rejection from going the other way, even though there's a big push in, got you, we're going up. So hidden divergence is a trend continuation. Okay, it's a potential trend continuation setup. Now, let me just give you a quick example here. Now, so once again, you see on this chart, the numbers on the top, that's measuring the strength of the pushes up in this uptrend. The numbers on the bottom are measuring the retraces, the pullbacks against the trend, right? So don't confuse these two numbers. And again, in an uptrend, we're wanting to see the measurements of the pullbacks, just like, hey, we want to see if that trend's continuing. We're pulling back on the slingshot. We've got the archer pulling back on the compound bow and seeing how much strength they're pulling back with so that we can blast off back in the direction of the trend. Here's an example of a downtrend. The market's trending down, right? Making lower lows and lower lows and lower lows. So these bottom numbers is measuring the push down in this downtrend. These numbers up top are measuring the pullback or retraces. The pullback or retraces. Pullback or retraces. Check this out here. 965%. That pullback had 965% more volume than the last pullback, but it got rejected and kept continuing down. Nice, right?
And that other one had 446%.
Yep. And then see this one had a little bit of pullback, 175. And then this one here, this pullback, 780, 446%. What we want to see to qualify as hidden divergence, the way that we define it, we want to see a minimum of 125%.
And one thing to point out is on the uptrend, he looked at the bottom numbers. On the downtrend, he's comparing the top numbers. So on an uptrend, he's looking at the bottom numbers. On a downtrend, he's looking at the top numbers.
Right, because we want to identify the trend And we want to measure the fight that's going against the trend, against the trend, against the trend. Because we can see that there's a big fight that gets rejected. That means we're not done. Okay, Nikita says, explain 125%. Okay, Nikita, so we're in a downtrend, right? And we want to, therefore, we want to measure the pullbacks against the trend, meaning the trend is going down, but here the market retraces up. And right here, we see the volume in this retrace, the momentum in this retrace, measured at 608, 608. And then it comes on down some more. And right here, it pushes back up again. It retraces again, but only on 175. So this retrace, this pullback up, was a lot less than the last pullback up. It was only 29% of the last retrace. So it was a weak retrace in
It has to be
compared to the
greater.
last one.
It has to be greater, or 125% or greater for you to count it as HD.
Right. So
Hidden
then,
divergence.
right. So then notice it comes back down further in the trend direction. Then it pulls up again. And what does it do? This pull up measured 780 compared to the last one of 175. So this is a much stronger pullback. In fact, it was 446% of the last pullback. So that's what we mean by 125%. For example, you have a downtrend, you have a pullback to the upside, you want that number to be 125 or greater, okay? Because, you know, Daniel says, does greater than 125 signal anything better in probability? You know, the stronger the pullback, the greater the probability can be in a sense, okay? But also a really strong push to the other side could also mean the start of a different trend direction. But that is why, that's a great question, Daniel. That is why, okay, and I'll answer that question here in just a minute. Okay, Daniel? So, does everybody get that basic concept of hidden divergence? Trending market, we want to measure the pullback against a trend. Okay? Nikita says if that candle was a setup candle, we'd have more confidence to take. Absolutely, yes. Okay? Yeah, Patrick, we did talk about that. Don't worry about the different colors. The yellow color just means it's kind of a double top or double bottom, meaning it was just measured around the same spot of the last retrace. Okay? Yes, with the oscillation detector, you'll need at least 2 bars retrace to get a number. All right? Now, so that is hidden divergence with the oscillation detector. Now, there's another way that we also can view hidden divergence on our sniper charts. In fact, it's already on your chart. You just probably didn't realize what it was. And these measure a little bit differently. Okay, that way you have some different views of the market, different views of measuring strength. All right, now it's stronger if all of them line up, but it's not required. Let me show you here what I'm talking about. Notice when I took everything else off the charts, I left a couple other things on here. Okay, do you guys notice? Let's see here. Do you guys see these icons, these colored icons in here? Right in here? You ever notice those on your chart and wonder what they are? Well, there's 3 different icons, all right? There's a green, there's an orange, there's a yellow. Okay? One of them is for divergence, which we're going to talk about on Thursday. But the green and the orange, okay, and let me just show you here. You could literally click on them. Okay, and it'll show you right there. Early hidden divergence signal, orange. Early hidden divergence signal, lime green. There's basically 2 other apex indicators and algos that are written into this. Okay, and they measure things differently. For example, right here. See this push down? And then you get this oscillation detector number, right? Well, we have some other versions of indicators that measure strength. Notice this push down. See, there was an up close bar here, one up close bar, and then a reset. It did not take that into account. It measured from all the way up here, all the way down here. So that kind of gives you an overall big highest top to lowest low measurement. We have some other indicators that actually would just measure here to here, down, and literally would measure this one bar up, and then have a new measurement from this push down to here. Okay? And then some a little bit different indicator that comes in that would measure from the the change of direction to I don't want to bore you with all the different things, but basically some of them take into account a retrace, some of them don't. It helps you look at the market in different ways. Just like we have our 10-tick charts, our 60-minute charts, 240 minutes, 10 minutes, we get to see it from different ways. So the green and the orange will show you when there's hidden divergence based on those back end apex indicators. Okay? So you actually get to see the oscillation detector plots and the percentages to be able to see when those line up, okay, 125% or more. But also on the chart, these will pop right up as these bars close. And you'll be able to see, all right, we have a down, we're going down, or we had a reversal bar. Boom. Now this next reversal bar closes, bam, bam. We got an orange, or we got a green, or we got both. We're technically in a state of hidden divergence. Next bar, still in a state of hidden divergence, hidden divergence, hidden divergence. What would have happened, do you think, if another bar closed up and then another bar closed up? You think if another bar closed up here, higher than this last pullback, would that still be plotted as hidden divergence, or do you think it would stop plotting then? Because it's only considered hidden divergence if it has not broken the last high. Does that make sense? Let's see if I can find an example of one here like that. Right here. See? This push down, so reversal bar, hidden divergence, reversal bar, hidden divergence, boom. When this bar closes here, and it's, hey, it's equal to this last, it's no longer in a state of hidden divergence. The hidden divergence has to stay through the reversal bar. Okay? So does that make sense? Here's another example. We're pushing down, pushing down, pushing down. As this comes up, you see the oscillation detector here, 229%. So just looking at this down trend, this pullback here, looking at the oscillation detector alone, are we in a state of hidden divergence? Yes or no? Who can tell me? Yes, because it's 220. Because for one, the biggest part of that question I just asked, or that statement I just made, was we're in a downtrend. And this pullback was 229% compared to this last pullback. So we're in a state of hidden divergence. Also, what do you have here? You've got a green and an orange, which means both of the other back-end apex indicators also registered hidden divergence. So do you feel pretty good about it when you have all three and then a reversal bar? Okay. Yes.
So that increases your probability. Yeah.
It increases. Now, it is not required to have all three. You can have just oscillation detector. Sometimes the oscillation detector might say, oh, we're only 100% or we're only 80%. The oscillation detector might not say 125%. But you'll still get one of these green or orange, and that's okay. You can still consider that as hidden divergence. It's okay. They don't have to all line up. But when they do, when you've got, okay, I've got a clearly defined trend, and I've got a pullback that's over 125%. So that's one volume momentum measurement telling me yes, hidden divergence. And I've got an orange, that's another one telling me hidden divergence. And I've got a green, that's another one telling me hidden divergence. Do you feel pretty good about it when they all three line up? Again, they don't all have to line up. It can be just one, but when all three are there, that's when you really get into stacking your odds, right? Now, hidden divergence is not a standalone trade. We are not telling you, oh, look, it says hidden divergence. All three of them say hidden divergence. So that's great odds. If there's a reversal bar, just enter and go short. No. Okay, you do not. Okay, you were right, Stephen. We do have to have a TX as well. These are not standalone trades. You don't take a trade just because they're hidden divergence.
I'm going to add that probability of exhaustion in your favor.
Correct. Daryl just said it, because what was I talking about earlier? How this is a different view, right? The trend is down. They're trying to fight the trend, get rejected, no. Try to fight the trend, get rejected, no. You know what? We're going to come in with a ton of volume. We're going to start piling in orders, get rejected, and push down. Kind of the same type of scenario we talked about when we explained trapped orders, right? Right at the end here, they're trying to come in. Nope, we're going the other way. So when you combine all that push and rejection, not only at the top of that bar with the, or the top of this bar with exhaustion and trapped, but also when you see it on the overall push getting rejected, again, it just stacked those odds in your favor to make that a much higher probability trade. So these are to be combined with sniper setups. Okay? You have the hidden divergence, you have a reversal bar, you're adding in trapped orders, you're adding in exhaustion boxes, and that hidden divergence just helps you see those good potential points of that trend continuation. Okay, when that large push comes in and gets rejected and reverses, add it all together, and it just helps to be a much higher probability. Okay.
And you also don't need DR to confirm this trade.
Correct. So does that make sense why this is powerful? For those of you that watched some of the other webinars, and when I went in and explained what's behind trapped orders, what's behind exhaustion boxes, you understood why that was powerful. Do you see now why adding this in when you see this, why that is powerful to help give you a good idea about that trend continuation and adding it all in together and stacking those odds? Okay, so how do you do that? Well, this should be very familiar to you. Like I said, this webinar kind of assumes you've watched the past webinars, is that you understand what is a trapped X box and what is made up of that what is a exhaustion box with a trapped order. So identifying the pattern, we're looking for that trapped X box on that reversal bar that's going and continuing with the trend. We want the oscillation detector to show 125% or more. Okay. DR is not required. All right, Daryl just mentioned that. That is a big rule to our regular filtered TX trades, right? Okay. That they have to be in the same direction as DR. But in a trend, when you have a pullback, a hidden divergence pullback, because the strength of that pullback, because that pullback's so strong, it can go a little further, which can cause DR to flip the other way. And normally we wouldn't take that trade if it's against DR. But because of the power of that hidden divergence, you can take that trade with the trend if there is HD. Okay? So keep that one difference in mind. That's one of the biggest differences in the rules with this trade is DR is not required as long as it's trending and there is hidden divergence. Okay? So I already showed you we have the other two indicators on your chart, the green and orange icons that also show you a way to view hidden divergence, give you that alert when they pop up based on some different indicators. Okay, they do not all have to line up, and they don't have to line up with OD, but when all three of them confirm, that's even better. Okay, so I'm going to have you stop again and stop typing, stop asking a question, stop looking at this on your chart. Pay close attention right here, okay? Because this will screw you up. Just because you get an HD icon or just because you see an OD that's more than 125% does not mean that that's a valid trade. The icons, the algorithms are programmed in just to compare a last move with this move. The algo has no idea if the market's trending. It has no idea what system you're trading or what walls or levels are in the way. All it's doing is its job. Okay? Like the icons don't know if the market's in a trend. It's just comparing one leg to the other. It is up to you first. Let me say that one more time. It is up to you to first verify the market is in a trend. You should never ever be looking for hidden divergence if you have not already first confirmed the market is in an uptrend or the market is in a downtrend. Like, you shouldn't even be looking for it, okay? Because the market has to be in a confirmed trend already, had already made one pullback, and then confirmed and gone further. Then when it's time to make a second pullback, you can start looking for that hidden divergence to help you possibly confirm a trend continuation. Okay? Then you start looking for that setup. But always, always, when it comes to hidden divergence, you establish the trend, wait for the first pullback, let it go further, wait for the second pullback.
Does that make sense to everybody?
Any questions on that? Okay. On this screenshot here, wow, 360%, 216%, 218%, 200%. Whoa, 393%. Lot of them in there, more than 125%. I see some icons, I see some green, do I care?
Nope.
What is wrong with this chart? Do I get excited and start getting to press a button just because I see 273%? Do I get excited because I see, oh, that's those things John and Daryl talking, green and orange, get ready to press a button? This is a choppy, rangy chart. The words HD, hidden divergence, should not even be in your vocabulary right now. Do you see the difference of this chart that's right in front of you compared to this chart right here? Is there a clear, distinct difference? Down, lower low, lower low, lower low, lower low. Okay, I get a lower low and a pullback, a lower low and a pullback. Hey, I'm in a downtrend. Let me start looking for hidden divergence. Oh, there's hidden divergence. Great. Here.
Now do we have a TX?
Yeah. Then, do we have a sniper trade? Do we have a TX? Again, they're not standalone trades. We don't take them on their own. Do you guys understand the difference here? This is the biggest problem. This is the biggest point of confusion. The most questions I've seen in all the rooms of why didn't this hidden divergence trade work out for me right here? because I had this green and I had this 200%. You're in a ranging market. Okay? Everybody get that? Okay. So look, everything else from here on out is the same. All right? This is your standard sniper trade. It's the same entries, the same exits, the same stops. Okay? You have the same rules of obstructions. We don't want to trade into walls. We don't want to trade into levels. No, we don't want to trade in the deviations, the walls, the stacks, the flux, the dynamic magnetics. Same rules there. Really, the only different rule here is it can be against DR. All right. So does that help you guys understand the basics of hidden divergence and what to look for? Any specific questions on hidden divergence itself? Or what we've covered tonight? Do you think you'll be able to use this tomorrow in the room and say, okay, hey, there's one. Like, we've got a couple hundred of you on this webinar tonight. I think it'd be pretty cool if we had a couple hundred people calling out HD trades tomorrow in the room, right? Or if you're not sure, ask. Hey, is that an HD trade? Hey, boom, got some icons. Hey, I see that OD is above 100% and we're trending. Guys, possible HD trade coming up here. Let's see if we get a reversal bar with a TX trade. Okay, let's start thinking ahead and looking ahead. If I did get a reversal bar with a TX trade, is there clear room there, or would I be going into a deviation, or would I be going into a wall? Okay, makes sense? Andrew said, so just above 125%, you are not comparing the percentages getting less or more. I'm not sure I totally understand your question there, Andrew. I'm sorry.
It is about less or more. Yeah, I'll just move on.
Okay. Okay. Daryl, anything you'd like to show or review?
Um, y'all want me to look over maybe a few trades on ES real quick for you? The Understanding the Charts videos covers the 5 major levels. Okay, let me take over here. All right, so I got ES right here. And so looking at this, what is that? Would you be looking for HD in any of this right here? Exactly, choppy range bound. So right there, would that be HD? Now, does it have a reversal TS? Does it have a trapped Xbox on it? So it's 200% compared to the previous one. So it is hidden divergence, but it doesn't have a TX. So the entry, we'll find one, and I'll go over the entry, the stop, and the take profit. Okay, so we're going up over here. We don't have one. Down, then up. Number's not greater. So we're just literally looking right now for trend-based TX trades. So that's trending down, but we don't have an HD on it. You can find more of these often on NQ, but I thought I'd look at ES.
Yeah, and these aren't
Okay.
trades that you're going to get a million of every day. You're going to, first of all, just be looking for them in trending markets, and they're just higher probability trades. Being a
Okay, so
sniper.
So looking at this one right here, we had 17,000 on this pullback. We didn't make a lower low. We had 34,000. And we have a trapped X box. So can we take that trade long? Yeah, it's HD with the TX long in the direction of DR. That's a lot of good things. DR is not required, but that's just another positive. And so we enter one tick above the high of this bar. We ever stop one tick below the low of this bar. We take our profit when two bars have closed up, which is right before that magnet and dynamic magnet. So right there is an HD trade that was profitable.
And a mini magnet on the reversal bar. That's doesn't get sweeter than that.
Now, I see this bar forming. Which of the automation tools can I click to take the trade for me? So I can use this ODD, DRD, ETX, whatever, basically everything combined. And I see that forming and I can click long on it and it will take the trade. So can you use the automation tool to take these trades? Yeah, you see one forming, you just click long or click short. So the regular TX trade won't take it if DR isn't lining up, but this one will. That's the big difference. Why this is trying to change my account. I don't want to change my account. So let's see here. No TX on that one. And so it doesn't matter if you're looking right or left on the chart, the way that these work, either it is a signal or it isn't a signal. It's objective. Would everybody agree that this is an objective signal? This isn't something that you have to figure out how to see. Like, it is what it is. You can use the auto trade. You can't use the filtered one, but you can use the ODD TX. So right here, we have 91%. I actually called this trade this morning in the room. Comes down, comes back up, doesn't make a higher high, 195%. We had a trapped X box. And so you'd hit the short on it, right? You'd leave it on until either it closed down, or if it closed up, you'd go ahead and, turn it off. Does that make sense? Like, I mean, is that objective? So I want y'all to make sure that y'all understand, like, this is not an interpretation. It's not one of those things, well, since I scrolled left, I was able to pick it. It doesn't matter which way you're scrolling. I mean, either the number is greater than 125% and there's a TX on it with a downtrend, or it's not. We don't worry about, on HD and OD trades, we don't worry about double clusters or coil chop. So I actually literally called this trade out in the room. Lori's like, I don't know. So, but the diamond above it means that it's a TX trade and it could potentially qualify as an ODD, DRD, ETX. That diamond, if you have the automated trader, is what makes it trigger, because that diamond will print right at the bar close to fire off the trade. Okay, so we have a HD here, but we don't have a TX, right? So no trade right there. So let's see here, not there, not there. Here we go. So we're trending down, we pull back, we're trending down, we pull back. This is right at the open here at 939. We got a short, one tick below the low of the dynamic magnet, which is perfect because it's not into it. We have our stop right above it, and we take profit when 2 bars close down. Okay, does everybody see that trade? Is that objectively seen? So some of these trades, somebody said also simplicity pullbacks. So a lot of times you'll see HD on an LRE trade, which is a simplicity trade. We're not talking about that in detail tonight, but you will see them at the same time. Do you think that gives you a lot of confidence on that LRE if you see a pullback and you get HD on the sniper chart? That give you more confidence on an LRE simplicity trade? So often you'll see them that way. So let's see, scrolling, see if I can find one more. Here we go. Okay, so it comes down 58%. It just now breaking that down. Down here, pulls back up. Again, we don't care about coil chop. We got this. This is an interesting trade because you didn't actually get a TX on the HD number. So therefore, it technically, would that be a trade or not be a trade, even though you got a TX here? Would it be a trade or not? Not correct. So we're looking, we're picky, right? We're snipers. Okay, here's the market trending up, trending up. Here we go. Greater than 125%. We got a trapped Xbox. That's what that black detector helps you see at the bottom. Buy 1 tick above. Stop 1 tick below the low of the bar. Take profit 2 bars later, right here. You can do them during coil chop. But that one doesn't have coil chop. That's down, down, up. All right, so does everybody get it? Does that make sense? That's just from today. So I want to make sure I showed you trades from today, not like cherry picked from, you know, a perfect time. Yep, and it had a fall, even better. All right, so do y'all think that y'all might want to watch this webinar again? Yeah, this one also had all the divergent bars. It had the green and orange right there. That's a good point. All right, we're going to post it up on Facebook and YouTube here in just a few minutes. Okay, it'll go up. And then we'll post it up on the website tomorrow under webinars, recent webinar recordings. And we'll cover ODD next time. That's what the next trade is on Thursday. So make sure you register for that webinar. And also, I had a winner picked for a free month. And that is Shalon. So Shalon, I believe it's Shalon Winter, if I'm correct. Congratulations. Let me see here. Verify the name, but I'm giving away a free month each week. Yep, Shalon Winter is the one who won. So he's been very active on Facebook, been sharing, been posting comments, and been very helpful in the room as well. So again, each week I'm giving away a free month to one person who's very active on our Facebook page and group. So congratulations, Shalon. But make sure you register for the webinar, and we'll see you tomorrow morning in the room.
All right, thanks, guys. Have a great night. See you tomorrow. Appreciate it.